What's up, everyone? It's your boy Looney back with another video, and today I'm going to break down one of the easiest option strategies you can run even with a small account. And that is, I'm talking about call and put credit spreads. You could essentially use a fraction of the cost of selling options up to $50 to $100 a week without needing thousands of dollars in your portfolio. So let me break it down real quick. A credit spread is when you sell one option and buy another option at a further strike. And you also are using the same expiration. It does limit your risk and capture your reward, but you get paid up front. You can sell put credit spreads if you're bullish or call credit spreads if you're bearish. You could do this all with limited capital, often needing as little as $100 or $200 per trade. Now, this isn't a spray and pray strategy. Me personally, I'm very selective, and even now, I wouldn't be running these options. I'd be waiting for better entries, but at least being prepared to use strategies like this when a good opportunity arises. Because we're seeing stuff pump right now, and I'm very curious to see how the VIX and the Bollinger bands work right now. And that's what I want to go over. These are the things that I look at when I usually pull the trigger. So let me pull it up with VIX. So the VIX, which goes over volatility, when it's low, I'd say anywhere under 15 is a good time to do put credit spreads because stocks are pretty undervalued. Now, it isn't the only indicator, but it is a very strong indicator if the VIX is very low that stocks are trading low. So I usually hold off until it's that 15 mark. And then on the other side, if it's above 30 or 40 or even like 50 is when I really look at doing call credit spreads because stocks are a little bit overvalued or the market in general is pretty overvalued and we're due for a pullback. So timing is pretty key when it comes to this strategy. And then the other thing I look at is Bollinger Bands. So let me pull up Riot because I'm going to show you an example with Riot and show you how you can only use a fraction of the cost. So I went into this expand view to look at the charts, and I'm just going to pull up the 1 month. And right now I have the Bollinger Bands put on right here. It's basically those lines on the outside of the green. And I'm not going to go over too much, but basically the stock tends to trade between these two lines about 95% of the time. Now, I'm going back to my indicators. I have the Bollinger or BOLL 20 set, and that's how I got it. But I usually look at doing call credit spreads when they pass this Bollinger Band because that's when you know that there's a high chance of it going back into that Bollinger Band. So it's often due for a snapback, and I sell a spread in the opposite direction. So right now we're heading towards the upper Bollinger Band, so it would be a better thing to use a call credit spread. Now, if it was on the lower end, like here, let me actually find one that it crossed the Bollinger Band. So right here, where it went below would be a great time to sell a put credit spread. And then when it went above the Bollinger Band, it was a good time to sell a call credit spread. You could clearly see it didn't really go lower at this price point, and it didn't really go higher at this price point. I mean, yes, it went up a little bit, but I doubt it went up to whatever strike price you were choosing. So I'm going to show you an example on how to actually set this up. We're going to look at Riot because I did say that is a better time to sell a call credit spread. I'm not doing this trade. I'm waiting for even a better entry until Riot is super overvalued where it passes that Bollinger Band. But as we get close, we can look at it. So I have it pushed up to that 1 month and to today, or the most current. Right now, the Bollinger upper band says 8.93. So let's go to trade options. Let's go a month. The expiration date isn't super important. You can do 1 to 6 weeks. That's the golden ratio, I would say, or just the best expiration I would do, or at least that's what I do. Now we're going to go about a month out. So it's June 13th. And again, we are doing a sell call because we're doing a call credit spread. And I like to go very cautious or very selective and overall safe when I do these trades. So right now the market is not open, so the numbers are a little off, but I like to go anywhere from that 15 delta all the way up to 20 delta. I like to go below that 20 delta. So in this scenario, I would open up this 11.5 delta. Even this 12 delta seems pretty good. So you hit this sell call and hit that plus sign. And then to do this trade, you do need 100 shares. And the way to get around that is to buy a call. So we're going to go up just a little bit. I usually do 1 to 3 strike prices. This is the spread. Now, let's see. Let's do this $12.5. We'll do this up to. So is it good? It seems like it is good. Okay. Now, I'm really curious why it does this. It usually is a little different. I don't know why it's kind of going like this, but the max profit is $29. And, okay, sorry. This is, I'm starting to realize why it gave me that. Let's go to buy call and then do this 12.5. So yeah, now things are a little different. It has max profit of $3 because of that difference. Let me actually change that then. Let me go down to this one. Again, it has that $18. Okay, I'm going to slightly change it just because it is market close, so it's not going to be as accurate. Let's go down to this $25 or this $10. So let's do the $10 and then buy call. We're going to go up to that. Let's see, which one should we do? Let me go back to the sell call. Let's go to this 11.5. Let's do that one. Let's see how that one looks. So let's go down one. Let's do this. This one is good, right? Yeah. Okay. So right now the max profit is $11 and the max loss is $89. So to do this trade, you will need $89 and you can make a profit of $11, which doesn't seem like a lot, but when you do the ratio max loss to max profit, it is a very good return and you could actually really help out your returns by doing these kind of plays. And it is an alternative. So the way it works is the stock needs to stay below that $10, that $10.10. And if it does, you start to lose money and you can lose up to $89. If it stays below that at any point, you will get $11. Now you might think, why not just buy a put? And that's because it's a little bit more expensive and you need more price movement with buying puts. Now, if you go back to the Riot, it is very unlikely for Riot to go past or go up to that $11 or $10. And it's not impossible, but it is unlikely. I'm not doing this trade because I want to see things first. I want to see how the week plays out. But this is a great trade to do for smaller portfolios. Now, you want to stick to high liquidity tickers. You want to make sure the stock you are doing is being traded constantly. There's a lot of buyers, a lot of sellers, and Riot it's probably a lot lower than other stocks, but it is a highly traded stock. Number 2 is to use spreads on overbought or oversold conditions. And that's what I was saying. If Riot goes past its Bollinger Band, it's probably a good time to do the opposite or to hedge in any direction. And you could also look at VIX as well. And even RSI is also a good indicator. That's why I have that on the bottom. If that one goes past that 70 mark, is also a good indicator that the stock is due for a pullback. And the next thing is to set max loss and just don't over leverage. I wouldn't use this trade very often. This is a very small position trade. This is really when you are invested into a position and you just want that extra hedge in any sort of direction. And you want to do it for a very cheap and very small position like you just saw. I would probably open up maybe 2 of these trades or 3, which is be around 1% of my entire portfolio, maybe even less than 1%. So you want to make sure you are not over trading or over leveraging. And then to aim for spreads that are low delta. So you want to be in that 20 delta, somewhere around there. 30 delta is doable, but again, it's a lot riskier with spreads. If I were to just sell options, 30 delta is good, but if we are doing spreads, you want to go a lot safer and a lot more conservative. And for percent return, this is a very high percent return option strategy. And that's why with high risk, you do get high reward, or high risk, or max loss can be pretty high. And that's why you want to be careful. You don't want to do this trade too much or too often. You want to make sure your entry point is very good. So this isn't a get rich quick trade, but you can stack up that $10. If we did this trade 5 times, you'd need $500 and you'd make $50 in about a month. And then it adds up. So you can use that money to invest in other positions. Plus the risk is very capped, which is perfect for small accounts. You could even close trades a little bit early if you're getting nervous that you are going to lose the trade. And I have done that before. I have closed the trade early, about a week before expiration, for a loss or even a profit. I've missed out on some profit by closing early. And that's really the video. I wanted to just do a quick video on a small portfolio option strategy. If you want to learn more about how I pick strike prices, manage risk, and time entries, check out the Discord. It is free to join. And then I also have a upgrade where you can get my real-time trade alerts and coaching. It is a paid subscription. You can check it out. All links will be in the description. And let me know, are you guys running spreads in your account? Until next time, peace.